We are going to start discussing measures against the financial crisis, a joint debate on Jean-Paul Gauzès' report, Credit Rating Agencies, Renata Weber's report on reporting and documentation requirements in the case of merger and divisions, and Peter Skinner's report on insurance and reinsurance. So I would like immediately to give the floor to our first rapporteur, Mr. Gauzès, 4 minutes.
Merci, Madame la Présidente.
Yes, thank you, Madam President. Commissioner, colleagues. The report I've been responsible for on credit rating agencies was a particularly interesting one, and I'm particularly happy that we have been able to reach an agreement with the Council and Commission, which means that it's likely that this report can be adopted in first reading. Analysing the various reasons behind this financial crisis has showed that it was absolutely essential to establish regulations covering credit rating agencies. The draft regulation drawn up by the Commission has been analysed very closely by the Parliament to ensure that European rules and regulations act as an example, but at the same time are also efficient and pragmatic. The recent G20 conclusions further consolidated that determination. The compromise reached by the Parliament, Commission and Council is in compliance with the lines laid down by the Parliament on the essential points in this regulation: its scope, the rating of third countries as well, and also preventing conflicts of interest. But I'm particularly happy that this text has laid the foundations for European supervision in the spirit which came from the Larosière group. The Parliament wants SFCRs to be the single entry point for registration of these agencies. We knew that given the present state of law, it was not possible to do an awful lot more, but for the future we have laid the foundations for this European supervision. Over forthcoming months, the Commission will propose put forward a legislative proposal aimed at implementing the guidelines from the Larosière report in order to create European supervision which can be both coordinated and effective. On a temporary basis, and awaiting this initiative from the Commission, the regulation will be based on coordination of SFCR by a college made up of representatives of the competent authorities from Member States, the legal authority coming from the authorities in the place of the headquarters of the agency. I would like to stress today how, in the second round of these negotiations, the Parliament appreciated the constructive and cooperative attitude of the Czech presidency. It was because of this that, through some very intelligent work, we were able to draw up certain rules which should mean that we can ensure the necessary transparency and correct the difficulties and hitches which stemmed from the lack of any rules and regulations covering the rating agencies. So we're very happy with this result, and that is why tomorrow a global amendment will be put to the Parliament, which comes back to the text on which the Commission, Parliament and the Czech Presidency, the Member States in other words, have agreed. So the Presidency, Parliament and the Commission will have proven that in the face of an unprecedented crisis, the activity of the European institutions has really worked in the right direction, and I hope in the same spirit the other provisions within this financial package will be adapted, particularly the recast of the directive on banks' own resources, BAL II. I think it's absolutely essential that at this stage, when Europeans are questioning how effective Europe really is, it's essential that we can prove that Europe is there in the face of this crisis. Mrs. Weber, 4 minutes.
Vă mulțumesc, doamnă președintă. Colegi, cred că ne aflăm într-un moment în care...
Thank you very much, Madam President. Colleagues, we currently find ourselves in a situation where there's a great deal for us to do if European society is to survive. We need to be able to provide people with jobs at this time of major crisis. I welcome, therefore, the Commission's proposal for a directive which simplifies reporting requirements in the context of mergers and divisions. This is a way of improving competitiveness. The report we're going to be voting on tomorrow that I drafted goes in this direction. It focuses on the following points. Member states and companies will have more flexibility as regards reporting and documentation requirements in the case of merger and divisions. There is a need for a simplification because at the moment there are dual reporting requirements with all the ancillary costs. There are also rules on documentation requirements that need to be adjusted in the sphere of internet and new communications technologies. The idea is to be able to send a simpler message. The directives we have today go back a good 30 years and therefore urgently need updating. I'd like to thank all the shadow rapporteurs for their support in this process. And I also represent representatives of Council and Commission for their readiness and openness while I was drawing up this report. On the 7th of April, Coreper reached a decision following negotiations with Parliament on the adoption of a directive on this subject in first reading, and I hope that's exactly what happens. A number of amendments have already been put down for the vote tomorrow, but the trialogue compromise that we've arrived at is a good one. Internet publication in newspapers, all of these things have been discussed, resolved, and the result is a good compromise. As for publication in local newspapers, that will continue to be possible, but only in member states that want it. Paper copies will no longer be required where shareholders have the opportunity to download information from the internet. Member states shall, however, be able to ensure that companies make these documents available at their offices. The implementation deadline is 30th of June 2011, and it's important that that date is respected. The member states will be responsible for dealing with situations where information is no longer available, where there are technical hiccups. I think €154 million will be saved every year thanks to this directive. Thank you.
Our last rapporteur now is Mr. Skinner. 4 minutes.
Madam Chair, thank you very much. It caught me slightly unaware as I hadn't seen the complete change of the timetable today, but I'm very grateful for the chance to address the Chamber about a very important issue of the financial services industry, that is the insurance and reinsurance industry, and what we have done with the Solvency II report and how we have finally brought this now to the Parliament in order to be able to establish what I think will be a very concrete basis for regulation across the European Union. It is, of course, something which we are coming back to. There was Solvency I, and I'm grateful to Mr Ettel when previously in the Parliament that we discussed this at some length and we managed to come up with some basis. But now, of course, we have to modernise, and the insurance industry is amongst many financial services industries which have to be at the forefront of change. It is clear with the financial crisis and everything that has gone along with it that the insurance industry is something which cannot be left alone. There are several measures which come about from Solvency II which I think have helped to make this one of the leading reports which will be a global leader at that. Amongst them is the issue of management of risk, and I think that it is not enough now that regulators simply tick boxes to establish whether or not the industry that they are meant to be guarding and protecting on behalf of the consumer is doing the right thing. It is essential that the day-to-day business of insurance and reinsurance companies are actually watched, managed and monitored by regulators over a period of time. It is by this process and this process alone really that we will be able to establish a proper and appropriate form of regulation. It is the reporting of companies. Yes, they will be doing things to tell regulators what they are doing, but regulators will have to be involved. And across 27 member states. Not each individual member state with their own separate rules now, considering what they can apply in terms of that regulation, but indeed they will be applying a standard formula of regulation across the European Union, which will lead to, frankly, the better consumer platform of protection that we expect. Similarly, companies will manage to get economies of scale from this regulation, because now they will be reporting only in one way to each of the regulators. What they produce, what they have to say, what they do and how they report will not just be to one regulator, but could be to a college of regulators, especially for groups, because as insurance companies cross borders, of course, it is now important that regulators team up and work together to ensure that the appropriate levels of reporting, the appropriate levels of figures and what information are supplied are brought to bear to make sure that the markets are best protected. It was during the discussion, of course, with Council that Parliament has seen some interesting and perhaps sometimes even deliberate ploys to move national industries one way or another. So I cannot pretend that this has not been a very difficult dossier to try to negotiate with Council. It has. Parliament, of course, has pushed Council a long way. It pushed it further than I think Council established and really wanted to go under the last two presidencies. So I am very proud and pleased to have worked with the team that I have in order to be able to get Council to move. Unfortunately, we will not have the kind of group support that we initially envisaged that we should. But because we are able to insert a review clause in this directive, we will be able to come back to group support, and after 3 years of the introduction of this particular directive, I am hoping, and I expect the Commissioner to tell me that he will anticipate doing this as well, be able to bring back group support in one way or another, specifically to match the economic side of this particular approach. We want a regulation that is risk-based and principle-based, but one that will also support the capacity of the industry, and one which will promote the very best instincts of regulators across the European Union and abroad. I will just finish on this one note. We must also challenge regulators elsewhere in the world and recognise country-to-country regimes only, and I hope the Commissioner will agree with me about that. Thank you.
Au nom de la Commission, Monsieur McCreevy.
On behalf of the Commission, Mr McCreevy.
President, honourable members, today's debate takes place at a time when we are facing the greatest challenge to the European economy in modern times. Action is needed urgently, vigorous, targeted and comprehensive action in order to restore confidence, growth and jobs, and to repair the financial system, to rebuild stability for the future, to promote trade and investment and to better protect our citizens, in short, to deliver an effective and stable financial system. Based on the Commission communication at the beginning of March, the Spring European Council set out a strong EU action plan for the future, a strategy to address the regulatory gaps in the financial sector, to restore incentives and to reform supervision to match the single EU financial market. In a few weeks' time, the Commission will present its views on the road towards building a state-of-the-art supervisory framework in Europe. These will be discussed by the heads of state or government in June, and the Commission is ready to put concrete measures on the table in the autumn. Clearly, global problems also require global solutions. The EU initiative to agree a coordinated global response to the financial crisis has been very successful. At the London meeting, G20 leaders made extensive commitments to address the weak points of the financial system in a coordinated manner, to jointly build a new financial architecture while defending an open global economy. The situation in the EU financial sector is serious, but a lot has already been done. And I am glad to note that the Commission, the European Parliament and the Council have reacted quickly and cooperated closely to respond to the crisis. We are about to successfully conclude the adoption of 3 key measures. 1. The regulation on credit rating agencies. 2. The recast of Solvency II, as well as thirdly the revision of the 3rd and 6th company law directives on domestic mergers and divisions. Firstly, the agreement reached on a regulation on credit rating agencies will help address one of the problems that contributed to this crisis and thus will offer some prospect of restoring market confidence. The proposal adopted by the Commission of last November sets some clear objectives for improving integrity, transparency, responsibility and good governance of the credit rating agencies. The thrust of the initial proposal is preserved in this regulation, which will in particular secure the analytical independence of credit rating agencies, the integrity of the rating process and an adequate management of conflicts of interest that existed before in the ratings process. Moreover, a comprehensive supervisory regime will be put in place. European regulators will supervise the conduct of credit rating agencies and take enforcement action where necessary. On the issue of supervision, I have been vocal about the need to strengthen supervisory cooperation. I have therefore no difficulty in agreeing on the need to push forward in this crucial domain. Therefore, in order to ensure consistency and coherence in all relevant financial sector regulation, the Commission agrees, on the basis of the recommendations of the de Larosière report, to examine the need to strengthen the provision of this regulation with regard to supervisory architecture. On the issue of the treatment of credit ratings issued in third countries, the outcome of the G20 summit has changed the global situation. All G20 members have agreed on regulating credit rating agencies through the introduction of mandatory registration and oversight regime. That is why I agree with the solution agreed in the negotiations between the Council and the Parliament on the treatment of ratings issued in third countries. I am pleased to note that the ambitious goals set by the Commission proposal have been kept. The Commission is very pleased with the outcome of the codecision process. So let me now turn to Solvency II. I would like to thank the rapporteur, Mr Skinner, and the Parliament for their work and their willingness to compromise in order to reach agreement in a single reading on this important subject. Such an outcome will be widely welcomed by the EU insurance industry, by supervisors and by stakeholders in general. However, I also have to admit I am disappointed with certain aspects of the compromise. The deletion of the group support regime, which I consider one of the most innovative aspects of the Commission's proposal, means that we will not be able to modernise, as much as we wanted, the supervisory arrangements for insurers and reinsurers operating on a cross-border basis. I also remain concerned that some of the amendments regarding the treatment of equity risk could result in the introduction of an imprudent regime for investment in risk-based capital. This is particularly the case for the amendments to introduce the so-called duration approach as a Member State option. The Commission will pay close attention to ensure that the implementing measures brought forward in this regard are prudentially sound. Nonetheless, the Commission will support the agreement between the Parliament and the Council if it is endorsed by your vote. The current solvency regime is over 30 years old. Solvency II will introduce an economic risk-based regime that will deepen integration of the EU insurance market, enhance policyholder protection and increase the competitiveness of EU insurers. As confirmed recently by SEOPS in their report on lessons learned from the financial crisis, we need Solvency II more than ever as a first response to the present financial crisis. We need a regulation that requires companies to properly manage their risks, that increases transparency, and that ensures that supervisory authorities cooperate and coordinate their activities more effectively. Solvency II will bring about a regime for the insurance industry that can serve as a model for similar reforms internationally. The introduction of a review clause specifically mentioning the group support regime will enable the Commission to come back to this issue. I expect that progress in a number of different areas connected to the recommendations of the de Larosière report will have created a more favourable environment for reforms related to cross-border cooperation between home and host supervisors. I now turn to the Weber report. Thanks to the efficient work of the rapporteur, Ms Weber, it has been possible to identify compromise and simplified reporting and documentation requirements in the case of mergers and divisions of public limited liability companies, which will maintain a very significant part of the savings potential of the original Commission proposal, which amounts to €172 million per year. Measurements and studies carried out in the context of reduction of administrative burdens show that the company law is one of the most burdensome areas of the EU acquis. For several reasons, administrative burdens hit SMEs harder than bigger companies. An excellent report from 2007 estimates that small enterprises spend 10 times the amount that large enterprises have to spend in order to comply with information obligations imposed by legislation. 10 times, I repeat. And at the same time, small businesses are the backbone of our European economy and are currently facing very difficult economic times. In the current difficult and challenging economic situation, we cannot afford such impediments. Instead, we must strengthen our effort to ease the burden on our companies. In its resolution of 12 December 2007, the European Parliament welcomed the Commission's determination to reach the goal of a 25% reduction in administrative burdens on undertakings at EU and national level by 2012, and underlined that it would examine legislative proposals in this light. Today, only 7 months after the proposal was put forward by the Commission, I am very pleased with this compromise, even though the Commission had gone even further in its original proposal. And I look forward to Parliament's endorsing this compromise, which will rapidly bring significant benefits to companies, especially to SMEs. And we shouldn't stop there. Simplification and reducing red tape will remain at the heart of the Commission's agenda.
Je vous remercie. Pour la Commission des affaires économiques.
Thank you very much indeed. Mr Mitchell now for 2 minutes, please.
Chairperson, thank you very much indeed. I don't want to aim this at anybody in particular, but I do think that Solvency II and regulation and CRAs are all very relevant and very important. But, you know, we need to, I think, build a fire station as well as douse the flames. And I think we've got too much into the detail of saying, oh, we're going to build this fire station at some time in the future. I cannot believe that if Sarkozy was still president, if President Sarkozy was still president of the European Council, I cannot believe we would still be going at the snail's pace we are going. The Czech presidency is a great disappointment, and the President of the Czech Republic in particular is a great disappointment. And can I say to you that if the Czech presidency or their successors are not capable of doing the job, then it shows that we really do need Lisbon. We really do need somebody on a more permanent basis to give leadership to the European Union. People are looking for hope. They are looking for some information about recovery. Does anybody in this House really believe that if Jacques Delors was president of the European Commission, we would be going at this snail's pace? It is time for action and for leadership, and we are not getting that action or leadership. And that is, Madam Chairperson, an issue which needs to be raised here this morning. The European Investment Bank could do much more. The European Union and its institutions, together with countries like China, could do much more. This is not 1937. We did not have the institutions, the capability of addressing things that we have now. We do have those institutions now, within the European Union and outside of the European Union, a small number of institutions that can cooperate together. What we are missing is leadership. Bring back Sarkozy, or somebody like Sarkozy, and let us get the Commission properly led to give people hope, and let us start talking about that recovery. I do not see this coming from the European Council, and it is time it did, Madam Chairperson. Thank you very much.
Commission des affaires juridiques.
On behalf of the Legal Affairs Committee, Mrs Bowles, 3 minutes.
Thank you, Madam Chair. I welcome the agreement for Solvency II and, like others, regret the relegation of group support to a future review and the eventual inability that we found in the Council to explore with us ways to make it workable, taking into account some well-founded concerns. In both Jury and Econ, I looked at what happens to the movement of capital at times of group stress, such as near insolvency, and it is certainly not as straightforward as the Commission draft or insurance industry representatives portrayed. However, there are instruments available that could achieve the objective, and we recommended level 2 measures. But now we are left to look for the future for ways to maximise safe economic use of capital in a group, and I hope that Member States will rise to the challenge when it comes to looking for better solutions on winding up. Now, turning to some of the things in the package, changes to Article 27 specify that supervisory authorities must have relevant expertise and capacity. I made the original amendment in part with the report into equitable life in mind, but in the context of the financial crisis it has a wider resonance, and I have achieved similar inclusions in the capital requirements and credit rating proposals. It must be absolutely clear that taking a risk-based approach is not a soft option. Proper understanding of models and underlying assumptions should be a more intensive way of supervising than tick boxes. Stress tests must challenge beyond the comfort zone of assumptions, and correlation factors should remain under active review. Group supervision is now made an inclusive process, not winner takes all for the group supervisor, although there has to be responsibility at a single end point ultimately. The role of SIOPS is augmented, and it is worth stressing that it was the discussion around Solvency II that led the way towards mainstream thinking on enhanced roles for the Level 3 committees. Importantly, it is also clarified that there should not be conflicts between the mandate of a national supervisor and its role within SIOPS. These amendments were somewhat prescient when made quite some time ago, but have shown their worth as the financial crisis has developed. And as the rapporteur has said, the Parliament team has done well, and in the context of Solvency II, so has the Czech presidency.
Nous allons maintenant passer aux orateurs au nom des...
We're now going to move to the speakers on behalf of the groups. From the EPP, Mr. Hoppenstedt, 3 minutes.
Ja, vielen Dank, Frau Präsidentin, Herr Kommissar.
Thank you very much, Madam President, Commissioner, ladies and gentlemen. We've heard from the rapporteurs where the critical points lie and what the positive outcomes are regarding Solvency II. And I think we can note that we've taken a significant step forward to bring Europe's insurance sector into a future-ready state despite the crisis. So we've heard what the difficult points are: group supervision combined with group support. There more needs to be done. But in the crisis situation where the capital flows are not the same as in usual times, it's understandable that we need to do more, and we have to take into account those countries where there are difficulties. We also, of course, debated the significant issue concerning share risks. We do, after all, have 500 million citizens who are all insured, and I think there will be a review at some point in the future. I think we have sent an important signal. The European Union is saying it is moving, it is able to act, and I think that in the United States, China and elsewhere this will be noted, because in those countries they're also working on legislation in this field. I think the message we're sending has been noted, and that's very important. As for the past, I just want to say one thing. We've had negotiations with 4 different presidencies. The negotiations were marked by particular pressures from individual member states, but we did make progress in the negotiations, and we also worked with the insurance sector in Europe. The impact studies on the various sectors were very significant. The insurance sector is a complex system, and we needed the industry on board as we move towards a solution. And with 1,400 big and small companies involved in the last impact study, that demonstrated clearly that we were able to succeed by bringing everybody on board. The Solvency II negotiating team didn't let itself be bullied by any particular sources of pressure. We have worked in a way that lives up to people's expectations of us as parliamentarians. Thank you.
Mr. Pitella now on behalf of the Socialist Group for 3 minutes.
Grazie, Presidente.
Thank you, Madam President. Well, colleagues, I think it's quite clear to all of us that we've come to the end of a cycle of development which over these last 4 years has brought to light contradiction and imbalance in a way of approaching globalization. Ultra-liberal globalization, which in too many cases has given rise to weakness in institutions and has seen politics as a mess, something to be shaken off. But it's now up to us in the political world to re-establish trust among the citizens in the face of this huge crisis. Obviously, it's up to the political world to take the lead, showing the obstacles to be overcome. We have to get to the end of this contradiction between rapid growth around the world and weakness in institutions so that we can establish control in the face of the world of finance. Now, I think that a major step is being taken in the right direction with this report on the CRAs. And I've been involved as a shadow rapporteur on that for the Socialist Group, working fully alongside Jean-Paul Gauzès. And I would really like to congratulate him on his work. I think the most important work have stemmed from the work of the Parliament in the tough negotiations with the Council. We have the requirement for registration now for those agencies based here, civil liability, a double insurance system for notations for agencies coming from third countries, and also the possibility that this regulation will come into force very quickly, not 2 years on, as was originally requested by Member States' governments. But I think that this is a highly symbolic report as well. We are regulating here a sector which, as with many others, speculative funds, for example, over the last few years, have lived in a legislative vacuum. The results are obvious to everyone, dramatic results. It's a time now to stick our necks out and build a new market. We have to become much more aware of what the real situation is in this sector, because, Mr. Commissioner, it's not enough just to have a guideline approach by Member States' governments. This is something we have to do. I think we missed out beforehand, and that's a bit of a shame. But we've missed opportunities. And one example of that is because Member States were against, and this is the responsibility of the Council, I think, the one big point missing is one single body to supervise these agencies. And as I say, there isn't enough political ambition and realism for us to be able to get that on board. And the Parliament, on that point, is still putting its foot down and saying we have to look well into the future. And I do hope that national governments will start to do exactly the same. Thank you. Mr. Klintz now, please, on behalf of ALDE, for 2 minutes.
Die Versäumnisse der Ratingagenturen im Vorfeld.
Ahead of the crisis, the rating agencies made mistakes. That means changes are necessary. What we're bringing now is more transparency, better quality, more competition, overcoming conflict of interest and better investor protection. It wasn't easy to achieve agreement. Commission, Parliament and Council were to start with far apart. But all in all, I think we have now achieved many of our objectives. One of the positive outcomes is that there will only be one category of rating agencies. There won't be category 1 agencies, category 2 agencies. Nor will they be able to carry out consultancies in addition to their rating activities. Rating agencies outside the EU will be able to have access to the European market using a certification system which is important for small agencies or a confirmation system which is important for large agencies. Nonetheless, I think there are some shortcomings in the regulation and in the document. I fear that the rules will de facto create difficulties of access to the European market. The rules are very restrictive and they could lead to the European market being cut off. This could be protectionism by the back door. That wouldn't be good, and I hope that my prediction turns out to be wrong in that respect. Secondly, our rules about internal management are bordering on overkill. We'd have been better advised to define clear principles and allow the companies to implement those principles as they saw fit. Thirdly, oligopolic structures, I haven't seen any progress there. We're going to have to live for many years without competition.
Mrs. Muscardini now, please, for 2 minutes. Thank you very much indeed, Madam President. Well, we're far from having solved the financial crisis, in spite of the fact that I think efforts made in Europe have provided some stability. The IMF states that the cost of the financial crisis is $400 billion, 2/3 of which can be attributed to the banks. There are huge objectives to be achieved. We need to re-establish trust, bring about growth and create jobs. And that can only be done if we follow an economic policy which can support the financial situation. But Europe as yet does not have an economic policy. Despite the G20 proposals from London to breathe new life into the credit system, as we've been saying for years, there's a serious lack of specific rules for the financial markets, its operators, the products offered and the derivatives as well. Markets should come under supervision and rules, particularly the financial sector, because without control, obviously, it's given rise to an unprecedented spiral of debt. And what are we supposed to do now in the face of that debit, which is that debt which has been given rise to on the basis of unsecured credit? Now, obviously, we're supposed to ban future operations along the same lines. We need to make the banks obviously act in a more responsible manner. We need clear answers to this. We need support for SMEs as well, so that we can avoid uncontrolled outsourcing as well. And we have to make sure that WTO rules are in line with the real situation. If we don't discuss world trade, we're going to solve nothing whatsoever. In other words, this is a systemic crisis, and in the face of that crisis, we need to reform the system and bring politics back in with policies which will control the situation. We have to come back to the real economy, and we have to move away from what we've had before, which was virtual finance. Mr. Lipitz, please, for the Greens, 2 minutes.
Madame la Présidente, Monsieur le...
Madam President, Commissioner, dear colleagues, first of all, I want to voice my full agreement with what Mr. Mitchell said. We are not working to the right rhythm. I mentioned that we shouldn't make the same mistake vis-à-vis the French president as the French do towards Mr. Gordon Brown. Speeches about what to do are not going to guarantee efficiency of what we actually do. On the crisis itself, it's clear that for us the crisis is not a financial starting point. We have to look at the ecological and social aspects, and we have to look at the cycles of the financial environment. That is to say, we take risks, and when it doesn't go so well, we have to perhaps regulate a little better. That's the phase we're in. We have to regulate. We have to have strong regulation. We have to regulate at the level of a single market. That is to say that we're going to need much more centralized European regulation. That's what guides us in our votes. We agree entirely with what's been put forward in this report, and for years we've been asking for supervision and regulation which is more centralized at European level, and the first step has been taken through CSER. That is a perfectly good step to take in our view. However, despite Mr. Skinner's efforts, and of course we agree with the criticisms made by Mr. Mitchell, we regret that the governments have not understood. The governments have not understood, and we don't agree with the compromise suggested here, which rejects the system of group supervision. I think that such a method will lead to further disasters. So we will vote against the Skinner report, but not against Mr. Skinner himself, of course, but against the compromise which has been imposed by the governments. Thank you.
Groupe confédéral gauche unitaire européenne, gauche verte nordique, Madame.
Mrs. Wagenknecht now for 3 minutes, please, on behalf of GUE. Well, colleagues, obviously, as in public security, justice, etc., the stability of the financial markets is a public good which should be publicly controlled. Because we've seen this with the regulation of the financial markets, the private banks, rating agencies, hedge funds. If it's all left to them, then huge sums will look for maximum credit through speculation, and in the end, obviously, it's the community which will have to stump up for the losses. And this crisis has shown only too clearly that self-regulation has failed. However, the Commission is insisting that instead of banning these risky financial products, we should have clear rules, and in the future players should be able to decide themselves what rules, what risks they're going to access, and how they should be assessed. That is irresponsible as we see it. It's quite clear that rating agencies act out of interest in products, in profit, and systematically underestimate the risks involved. And I think they triggered this in the first place. So I think it would be correct if risk management should be stopped in handing it over to these private bodies, and we should have a public rating agency for Europe which can act independently to assess the risks involved. This is a solution which has not even been mentioned by the Commission. The Gauzès report, I think, asks that rating should be seen as a public task, and therefore is something which should be undertaken by public players. But obviously that would only apply for state bonds. I think that for Solvency II, the Commission, the report talks also about this failed concept of self-regulation. The insurance companies should be able to take a look at the calculations of capital requirements and look at internal models for assessments. The supervisory authorities in member states as well should have enough capacity to be able to implement these rules. I don't know whether that will be the case. I'm rather doubtful about it, but I think that MCR and SCR requirements for the future are much too low and must be increased, because otherwise I think banks would be faced with problems. And we think that own capital should be boosted by the intervention of the states as well. But I think that part nationalisation along these lines would be a courageous first step to sorting out the markets. And in the longer term, the entire financial sector should be left in the under public control, because Only on that basis can we ensure that the financial sector will be able to play its due public role instead of looking for greater and greater profits on the financial markets. It's high time that we drew our conclusions from this catastrophe.
Independence and Democracy now. Mr. Bloom has 1 minute.
Good morning, Madam Chairman and Commissioner McCreevy. I've spent 40 years in financial services, so I think perhaps I know a little bit about what I'm talking here. Can I just talk a little bit about the FSA, the UK FSA, which will guide us onto the target, I think, of how mistakes are made. The FSA, the Financial Services Authority in the United Kingdom, has a rule book of 500,000 words. Nobody understands it, least of all the FSA. They interpret their own rule book in secret. They keep the fines which they inflict to beef up their own salaries and pensions. There is no court of appeal, and Commissioner McCreevy, I've written to you on this subject. It drives a coach and horses through your own Human Rights Act, Articles 6 and 7. No court of appeal. There is no legal recourse at all if they get it wrong. Regulation has been given the general public the view that if it has an FSA stamp on it, it can't go wrong. There is no concept of caveat emptor. Now they are going to be, it would appear, subsumed by some sort of EU overseer, consisting no doubt of ignorant bureaucrats, Scandinavian housewives, Bulgarian mafia and Romanian peg makers. You know, frankly, I think you're going to get on really, really well with each other.
On behalf of the non-attached now, Mr. Golnish has 2.5 minutes. Thank you very much, Madam President. The Gauzès report on credit rating agencies, the Weber report on mergers and divisions of businesses, and the Skinner report on the business of insurance and reinsurance contain all sorts of useful provisions. But I don't think you can call all of that measures to combat the financial crisis. The crisis we're living through has altogether different dimensions and cannot be resolved by these piecemeal technical solutions. What we need to do is to break with the dogmas of the past. What we have to do is assume that the international division of labour is wrong and doesn't work. The free movement of goods and capital has put European workers in competition with workers in communist China. The workers there don't have the right to strike, don't have the right to union membership, they don't have proper social protection. They live in a communist state which is a capitalist paradise. The free movement of people has led you to accept and promote a massive immigration policy, the results of which are disastrous. And the free movement of capital has been the trigger of this crisis because it led to the mortgage crisis, which was local to the United States and should have stayed that way, to contaminate by osmosis all of our economies and to ruin our people, our businesses, our savers, our pensioners. So we have to demolish the straitjacket under which our businesses operate. We need simple rules to ensure that monetary values are realistic. We need an investment policy, an investment policy that works. These are just a few of the things that we'd like to see the member state governments take as part of their national policies, which have shown to be more effective in terms of responding to the crisis. Thank you. Now, other speakers. Mr. Purvis, 2 minutes.
Madam President, I am pleased that Solvency II has at last reached the point of decision Mr Skinner and his shadows have displayed exemplary resilience and patience in achieving this. I am sorry also, like others, that group support and supervision are excluded, but not surprised, frankly, in the current febrile circumstances. We need to work hard to achieve a group system which will work for and in a truly European single market for insurance, and which is also effective with third countries. We cannot have any more AIG fiascos. I would also like to compliment Rapporteur Gauzès and the Council for reaching a reasonable conclusion to the regulation of credit rating agencies. Clearly, these agencies have made serious mistakes, and some form of increased regulation was inevitable. But who has not made mistakes, not least the regulators themselves, and can we be sure they are now above making any future errors? I was concerned that the rabidly hostile scapegoating of credit rating agencies would result in excessively intrusive and counterproductive regulation, with an overwhelming Eurocentric, protectionist and extraterritorial dimension. The compromise, I am glad to see, has muted these tendencies to some extent, but not to all the extent I would have liked to have seen. Credit ratings are an opinion. They are useful opinions, they are expert opinions, but they are only opinions. So it is up to investors to take full responsibility for their investment decisions. And no doubt these lessons have now been learned to some extent, and all too starkly and at a cost. I am glad the scope is restricted to ratings used for regulatory purposes. I am glad to see that we have moved away from equivalence and endorsement when dealing with third country ratings to equivalence or endorsement. But could the Commissioner please confirm that this means that investors can still invest freely in stocks and bonds in third countries which are not rated in Europe or which do not have equivalent status? We must be on the lookout for unintended consequences. With no prior impact assessment, these will almost certainly appear, and therefore the review requirement in Article 34 is of vital importance.
Please conclude.
Madame Berès, pour 3 minutes.
Madame Berès now has 3 minutes.
La présidente, sur.
Thank you, Madam President. On Solvency II, this reform was started before the crisis, and the crisis has shown us once again that as legislators we hesitated. We needed to conclude this under the first reading, but the determination of the negotiators enabled us to reach a compromise which I think has at least the merit on two fronts. First of all, the insurance sector will have to better evaluate its risks, which thus far was based on fairly old mechanisms, not appropriate to the modern situation in the insurance sector. And then also the need for supervisory mechanisms. They have to adapt to what new insurance companies actually are, faced with a multitude of products and offers made to the consumer, but also in terms of the transnational application. As legislators, we had to take account of the reality of the market, that is to say, a market in which, for example, in certain countries, there are life insurance mechanisms which are an important step forward for this sector. And in the light of the crisis, we have to take account of the significance of procyclicality when it is applied to the insurance sector. We also have to make sure that the implementation or adoption of this legislation does not upset the architecture of the market, the insurance market. And we have to make sure that mutual insurance companies also have their place within this legislation. But clearly this is just one step, and I'd like to mention 6 points on which we will have to look at again in the near future. The first, clearly, is taking account of the conclusions of the Jacques Larosière report and the need to make sure that there is a level playing field between the different colleges of supervisors, and in order to do that we need to boost European authority when it comes to supervising the insurance companies. Secondly, a lot of colleagues have already pointed this out, we need to have group support, and to this point I do not agree with Alain Lipietz. Of course we would have preferred to have the group support in place, but it's easy to understand that for countries where 80 or 100% of the insurance sector is in the hands of foreign companies without a certain sure legal base, it's difficult to accept such a mechanism. There again, we'll have to make some progress. The third stage for the future is harmonisation between what we do here and what's happening with the pension funds. We can well imagine that for insurance we have to improve solvency, but for the pension funds this is a huge challenge. The fourth field of work for the future is the setting up the establishment of a deposit guarantee mechanism, as we have in the banking field at the moment, which is still lacking in the insurance sector. A fifth point, commercialisation of insurance products and making sure, or supervising the way in which these products are offered to those insured, making sure that they take account of their need for protection and their interests. And the final point, the implementation in the sector of what we're going to set up for the banking sector, that is to say, the retention mechanisms when it comes to securitization. On this basis, in the future, we will be able to get a good, firm hold of this crisis and make sure we have an insurance sector which is a real guarantee to the public.
Madame de Sarnez.
Madame de Sarnez now has 2 minutes.
Position de la Commission.
Well, it's not the fault of our rapporteurs, but the Commission's proposals come very late and it's not up to the crisis. I think we need to be much more ambitious and proactive to face this crisis. On regulation, to begin with, we need to harmonise our legislation. And the strongest signal, no doubt, would have been to adopt a European regulator who could make their voice heard. As far as the rating agencies are concerned, we need to create European agencies whose independence would be guaranteed and put an end to this scandal of seeing agencies rating the institutions that they're paid by. Hedge funds, we need taxation which will penalise all sorts of short-term speculative approaches. Tax havens, well, very straightforward measures should be adopted. We should ban activity in Europe. Any bank carrying out transactions with tax havens we should refuse cooperation with them. So that will be for now, but we need to go even further. Let me give you 2 avenues of thought. Firstly, I believe that we need to start thinking about extending the Eurozone and bringing in new members. That political gesture, I think, would be just as strong as that of German reunification when it happened, and it would show inter-European solidarity and strengthen the clout of this union. And finally, we need to move towards economic, budgetary, monetary integration, tax harmonisation. That is the only way in which we can combat tax dumping in Europe. We need all of this. But what our citizens are expecting, and I want the Commission to hear this, is that we should legislate in response to this crisis. They are still awaiting a genuine European recovery programme, and they are still awaiting Europe to support our SMEs, programmes future investment, and supports all of those who in Europe have been struck by this financial crisis. Part-time workers, the unemployed, households facing huge difficulties now. That, I think, is the urgent point to be dealt with, and it's there that the European leaders will be judged tomorrow. Thank you.
Thank you. Mrs. Tomaszewska has 1 minute. Madam President, the implementation of Solvency II at this time of financial crisis is an important move. For years I've been working on pension insurance systems, and I know how important financial supervision is in the area of pension funds, given the mobility of workers and the need for transnational supervision. Since we're encouraging mobility, we have to put in place conditions which allow workers who change places of employment and insurance systems to have their pension contributions paid into the right accounts. We need community solutions in the area of investment principles and pension fund supervision. I congratulate the consultation panel in which I was able to participate, and I thank the rapporteur, Peter Skinner.
Madame MacDonald pour...
Ms. MacDonald for 1 minute.
Thank you very much. According to the Global Financial Stability Report of the IMF, the financial crisis, and this is an estimate, will cost $4 billion. That is an estimate that may rise. And this crisis has been brought about, as we all know, by the kind of casino capitalism, crony capitalism, and a financial services sector that has been subjected to no regulation, or light touch regulation as it is sometimes politely referred to. And the fallout of all of this for workers and families across Europe has been nothing short of catastrophic. And I am struck, Chair, in the debate and in the reports that have been produced at the very polite way in which we are addressing this scandal. I am struck at the fact that the Liberals and Christian Democrat groups are concerned at over-prescription, or that protectionism may be introduced through the back door. The fact is that the EU response to the financial crisis has been sluggish, has been minimalist. The fact is that we do in fact require a protectionism, and those that must be protected are workers and the real economy. We have yet to have a debate on the issue of jobs, although that is where it is at for citizens.
Thank you, Mrs.
And this institution, Chair, remains wedded to a system that has failed. Let us acknowledge that and be radical and brave.
Mr. Lundgren now for 1 minute. I would ask you please to respect your time limits because we need to get to the voting on time. So, Mr. Lundgren for 1 minute, please.
Ja, fru talman. En global finanskris skakar världen.
Thank you very much indeed. Well, obviously we're in the face of a global financial crisis, and we need to regulate and have more supervision in order to avoid this happening in the future. But I think we should start by asking what went wrong. Let me, in 50 seconds, sum up the reasons. Well, you know, we had this open-ended capitalism, out-and-out capitalism, and systems have been built up which provide huge bonuses as well, and profits are boosted in the short term, with risks being increased as well. And when that goes wrong, then nonetheless managers get their money and other people have to stump up for the losses. So no incentives either. The banks know that investment is probably guaranteed, but too many banks are too big to fail. So it's a taxpayer that pays up in the long run. It's very difficult to move otherwise. The finance ministries, the central banks have their own policies, and I think that what we need to do is discuss the solutions we need. But are we doing that? No. Thank you very much for respecting your time. Mr. Karas has 2 minutes.
Madam President, ladies and gentlemen, the economic and financial crisis, the biggest since the Second World War, is having global consequences. There is a crisis of confidence. There is impatience. There is desperation. All of this can be clearly felt. There is a need for regulation. There is a need for joint European answers. There is a need for the European Union to take a pioneering role in the world. Things are now possible which members of Commission and Council rejected just a few months ago. In Europe and the world, we need as much market as possible and as much regulation as necessary. We mustn't stop here, however. The debate is not over. It must continue. We must be courageous and resolute in our desire to establish European rules. We're far too late with the rating agencies. We need registration, we need control, we need to deal with conflict of interest. Solvency, that's something that would have been necessary even without the financial crisis. We need to adopt the banks directive. We need to deal with the hedge funds. We need rules for the hedge funds. We need rules for private equity. We need to deal with managers' pay. We need to deal with liability. We're still very behind with the European regulatory system. We need to build one on the model of the European system of central banks. Thank you.
Thank you, Mr. Karas. Mr. Goebbels has the floor for 2 minutes.
Madam President, colleagues, the Parliament is about to adopt rules governing international finance. They will be insufficient because clearly the political will does not exist in Europe or in the US to do away with pure speculation, unbridled speculation. For example, the sale of products which one cannot actually produce. The problem arose in the US through the city and other financial centers. All of these centers were supposed to be properly regulated. Nonetheless, we have also found the other guilty parties in the tax havens, the real ones and the false ones. We need a proper international architecture. In 2000, I predicted the elimination of all of the black holes in international finance, beginning with hedge funds and the other purely speculative funds. G20 is only going to regulate speculative funds, which they feel have systemic risks. Systemic risks are only found out in hindsight once the crisis has taken off. The G20 countries have only dealt with their own offshore centres, the Virgin Islands, Hong Kong, Macau, the Channel Islands, not to talk about the onshore places like Delaware. Now, in the future, the monopoly on speculation will be reserved to London and New York. The message is quite clear. International finance will be regulated for the pure profit of the large countries. Some things are more equal than others.
Thank you, Mr. Goebbels. Mr. Losko, 1 minute.
Presidente, colleghi, è giusto.
Madam President, colleagues, I think it's right to criticise and stress what's gone wrong, but I think we should also stress that today we're taking a step in the right direction. This crisis has shaken the whole of the world markets, but in its face, the Commission is coming up with very specific rules for insurance companies and rating agencies. I believe, at least from what I've seen now, that this directive on access to insurance and reinsurance is a particularly important one. Now, obviously, we've got an in extremis agreement with the Council, and I think it will tighten up the rules than what we've had on the real market thus far. Obviously, we've got the principles of economic assessment and ensuring that the rating is in line with the risks which genuinely exist. We have supervision coming in, and all of these, I think, are very essential aspects if we want to increase protection of insured persons. Various different solutions have been put forward to the pro-cyclical effects of what's happening, and I'm sure we could go further than what has been suggested, but I think that we have laid the basis now to take further steps in the right direction in the future. Thank you. Mr. Adamu, for 1 minute. Now, I think that the financial crisis now has made it very clear to us that multinationals and other companies need to be looked at more closely. We need to find regulations. We need to intervene to avoid the creation of monopolies and cartels which shake up the market and fix prices aimed only at making profit. Citizens are seeing the results of development without a social face, which avoids creating jobs and simply creates a lot of wealth in the hands of a few. Obviously, we need to take a very clear position on the situation of what's happening on the markets. The right has put its views forward on this so far. But I think that in the past we've had certain regulations which have failed. I'd just like to remind you that it's these policies which have given rise to inequality and poverty, a loss of income for a lot of people, and that is where we need to act. Our citizens are faced with the crisis. It's them who are paying for it. Thank you. Mr. Blokland has the floor for 1 minute.
Thank you, President. The first signs of economic recovery by the central banks of Europe and America has been predicted. But we shouldn't confuse things with this directive. The role of the rating bureaus in the credit crisis is hugely important. Investors rely entirely on the information coming from these agencies. If the ratings are not properly adjusted, the consequences are clear. The consequences cannot be avoided just by introducing new rules. Wording out or creating a fortress within Europe is not the answer either, but improving ratings is a good start. It's only a start, though. The European Commission has to work very quickly to harmonise the directives with third countries. Therefore, we have to start by working within the European Union and work centrally within Europe first of all. It is clear that more is needed for creating confidence in the financial markets. Let's start with a new sense of financial morality.
Thank you, Mr. Blokland. Mr. Langen now has the floor for 2 minutes.
Madam President, thank you. Today we have the first legislative proposals from the financial package. Solvency II was somewhat overdue. We can live with the results. We'll vote in favour. In the case of Solvency II, a number of problems have cropped up where we can say quite clearly that the market has failed and policy has failed. For years in Parliament we have called on the Commission to put forward proposals on aspects of the financial crisis. It's taken a long time, and what Mr. Gauzès has now negotiated is viable. There are independent criteria, new supervisory structures, and I think it is able to deal with this question of conflict of interest between agencies in an advisory and rating capacity. However, it isn't enough. Recalling the debate with UK Prime Minister Tony Blair, who addressed the House suggesting that he had the solutions ahead of the G20 summit in London, bearing in mind that the United Kingdom and other countries had previously refused to deal with certain issues which urgently needed to be dealt with. The bubble was a big one, and now it has burst. Manager appraisal and bonuses, other things that the Commissioner has mentioned, these things need to be resolved. Securitisation needs to be dealt with, and then in general with the de la Rosière report on European supervisory structures, we need a solution quickly. And we can't always wait for the United States of America. I would appeal to colleagues, let's do like we did with the climate package. Let's show the world what Europe can do. I think if we can do that, then we will have significantly contributed to resolving the crisis. Thank you.
Thank you, Mr. Langen. Mrs. van den Burg, 3 minutes.
Yes, thank you. First, allow me to make a comment, and that is that I'm surprised to hear all of these speeches given by members of the Parliament about leadership and about tackling capitalism. And these are all members who we didn't see when we were doing the hard basic work, trying to make sure that we had a good basis for the management of capital. I was the shadow to Mrs. Weber's report, and she's an example of someone who really did do the hard work and produced a useful report for the modernising and simplification of the tax burden on companies under European rules. That was a part of a large package of better regulation. And I want to emphasise that the better regulation is not just deregulation, removing burdens, it's also having better reactions, more flexible reactions to developments, with proper and clear authorities, especially for the supervisors who will be working. These are two important aspects in relation to the other issues being dealt with today. First of all, you shouldn't try to solve yesterday's problems. You have to look to the future and anticipate the future, and you have to set down a process which can react dynamically to developments. It can react to innovations. In the Lamfalussy procedure, which we developed, we have exactly that sort of process. That's what we put in place. The second thing is that you have to look at the level at which you engage in supervisory activities. The players on the market have become cross-border, they become international, so you shouldn't imagine that you can cope with the crisis with small-scale national supervisors. The large players dominate the market, and you have to be able to tackle them at a European and at a world level. And in my eyes, that also means that you have to have proper powers and authorities put in place in order to have direct supervision. When it comes to the credit rating agencies, of course, we did have this opportunity. That was the original approach of the Parliament, to have the CSER committee, the European Committee, and to make sure that it would have powers to sort out registration. Unfortunately, that didn't succeed, because once again there was a kind of tug of war between large countries, large financial sectors, trying to get hold of the major controlling levers, if you like, and people trying to get all of these credit agencies under their authority and supervision. In Solvency II, we saw this as well, because we didn't put in place the proper powers and authorities to be able to make statements at a European level and to sort things out if the supervisors do not agree amongst themselves. Doesn't mean we want to transfer their powers elsewhere, but we want to make sure that we have supervisors who are working on our behalf. So the provisions under Article 25 make it clear that on the basis of the Lazare proposal, we're going to have to try to improve and strengthen the system.
Thank you, Mrs. van den Burg. Mr. Schmidt now has the floor for 1 minute. Thank you very much indeed. Well, the financial crisis has shown that we have to act together in Europe. And we should remember that there are no longer 16 different currencies in Europe. We've got a euro, which has helped us, I would say. In Paris, there is no doubt that these countries got together and tried to stabilize something. So we had global steps taken, the G20 as well, tried for something new once again. And so many countries have been struck by this. But I think we should be better armed when the next crisis strikes. These reports, I think, are well balanced, but we need more transparency on the markets. We need more opportunities to have better supervision, etc. And we have to combat protectionism and support free trade. We also need to limit the risks. The free market needs rules and a framework as well. That can be liberal in itself, though. But I don't think we should over-regulate. Obviously, there is a movement towards that at the current moment. But a market economy creates wealth, and we shouldn't forget that. Thank you very much indeed. Mr. Wojciechowski, 1 minute.
Thank you very much, Madam President, Commissioner. At the beginning of this month, we heard that all of the necessary measures had been taken against the financial crisis. Apparently, the World Bank was going to get 100 billion. 250 billion was going to be put into international trade. Is there going to be better control of the financial markets and tax havens? President Obama heralded the G20 summit as the answer. Perhaps there's nothing to worry about, but why did world leaders take so long in putting into effect their recovery package? Why didn't they try to resolve the financial crisis earlier? Where did this billion come from? Was it 400? Was it the sale of 400 tons of gold? Nothing has been said about that. Or was the money borrowed from a bank? I would say to Barroso and Topolanek to meet again and find another billion to give us a turbo revival. Thank you.
Thank you. Mr. Skinas, 2 minutes. Thank you, Madam President. There is no doubt that today we are paying the consequences in Europe of a very centralised American UK model of organisation on the markets, which learnt to work without supervision, rules or a democratic approach. And obviously that has undermined the whole of the European and world economy. With these documents we're discussing today and we're going to be voted on tomorrow, we will be creating a shield of protection for the citizen, a shield of protection which will protect the citizen in the face of what we're seeing today with supervisory rules where they exist being national ones. Europe is therefore reacting. Maybe too late, but is reacting. Better late than never is what I would say. And obviously that leaves two major questions which still need to be answered. And the first is, why did we need to live this crisis before we reacted? Why did all this have to happen for us to get rules? The answer to that question will be given by politicians, I think. People were asking for rules. They will be rewarded as a result of this, and those who will be punished will be those who said that the rules are the wrong thing to have. And the second question is whether these reports that we're discussing today will be the only ones, or whether we're going to have a collective revision of the framework. Now, we have to give the answer to that second question, because as legislators we are going to bring pressure to bear to ensure that we don't only remain with the Gauzès report, which in the face of the credit agencies which didn't see the iceberg approaching, and we saw the results. Certain member states obviously had to get on board very quickly as well, but I think we need to take a very close look at this from the very beginning once again. We have to go back to scratch. Nothing is going to remain the same in the EU after this crisis we're facing now. Thank you. Thank you, Mr. Schinas. Mr. Medina Ortega has the floor for 2 minutes.
Yes, President. I merely want to refer to the Weber report on the proposed directive of the European Parliament to the Council, changing directives 7791, 78.855 and 82.891 on documentation requirements in the case of merger and divisions. We are in the process of simplifying administrative steps. Our position is in favour of the proposal from the Commission, because it does produce a degree of simplification, but we have included certain amendments which have been tabled by almost all the political groups, which I supported, and which make possible further simplification. We're talking, of course, here about a very important change: the elimination of documentation, the introduction of web pages and references on the web pages, reducing the types of requirement which have been demanded so far. This would mean there would be a fairly important reduction in cost and time taken. But we have to guarantee for those who are that all sides have proper guarantees set in place. The proposals which are made by the Commission are fairly positive. The proposals for change of the text which we're suggesting move in one direction, that is to say, a greater guarantee of independency, especially when it comes to the use of web pages. There must be references. There have to be information on the web pages, links to other web pages, so that life is not made more complicated. Finally, President, I think that this is likely to be adopted in Parliament by a broad majority, and that the text will be improved by means of the amendments which we tabled on behalf of the committee.
Thank you. 1 minute now for Mrs. Starkevičiūtė.
Thank you, Mr. President. The crisis has shown the size of the influence on the economy by cross-border financial groups, especially for small countries. And the current proposals should create the legal framework to manage two main processes. That is, aligning the free pro-cyclical movements of capital within the group of financial group with the needs to ensure the liquidity of the real economy and macroeconomic stability during an economic recession. And secondly, it should help sharing the responsibility between home and host supervisors to ensure supervision of financial groups and having clarity as to who will cover the losses if there are errors. We have to say that the current proposals are only the first step in this direction, and I'd like to stress that the problems will not be solved if the influence of competition law to the financial groups is assessed. We always forget this aspect, and this should be the priority of the new term of the Parliament. Thank you.
Thank you. Mrs. Pietikainen for 2 minutes.
Thank you, Madam Chair. I think that this package that is a part of this actions to deal with the financial crisis is fairly good when it comes to Solvency II and to the credit rating agencies. Will reach rather good compromises and outcomes. But then when we look on the future, I would like to raise three issues. Firstly, I would like to see the European Union to be more ambitious and active in the global level. Even though the G20 outcomes are steps in the right direction, they are still too modest and far from having a global proper convention based regulation both on funds and different financial instruments, plus on the regulation. Secondly, when it comes to De La Rosière and our own actions, I think that the outcome of De La Rosière was rather good, especially when it comes to supervising and analysing systematic risk on European level. But I would like to point out two pitfalls on here. Firstly, that relates to micro supervision. And I do see that the proposed model there, that would be still very much based on cooperation instead of a centralised European aspect, has its very strong problems. And secondly, what we have heard already from the EU Commission's preparation concerning the venture capital and hedge funds, there is quite a lot to be hoped and expected from there. And so if we really want to be effective on this level globally, we have to do properly our homework as well, and I really would like to see a better and more ambitious approach by the Commission on this field. Thank you.
Thank you very much indeed. Mr. Sanchez Presedo now has the floor for 2 minutes. Madam President, this package of measures on the rating agencies and business operations is a first step to boost confidence on the workings of the financial markets. The EU has defended provisions as has G20 to support transparency and integrity on the financial markets. And that means that the EU has been established as a world leader, I think. But we need to take things even further. The failures of the rating agencies are one of the causes for this crisis. Self-regulation is not enough. I think that this is going to be essential in creating more supervision for the agencies, tackling conflicts of interest, improving working methods and the quality of the different types of work, including those agencies which come from third countries as well. Obviously, in the future, we're going to have to take a look at the payment systems involved as well. The Solvency Directive looks at what already exists on private bodies. It brings in technological advances so that we can have better risk management, which will give rise to innovation, better use of resources, and will improve protection for insured persons and bring about stability. The new framework for group responsibility, I think, brings in new rules as well. There will be a college of supervisors brought in, which is a further step towards increasing supervision at European level, and that has to continue forwards. I think that could become a world standard. The Parliament will keep a close eye on this and will support its development. And finally, amendment to the directives on information disclosure on mergers and divisions, I think, is pushing for legislative simplification. It shows that this can square very clearly if you reduce the administrative burden and you have the 25%, but at the same time you increase the rights of the public and shareholders using information technology. Thank you. Mr. Dianu has the floor for 1 minute.
Madam President, I am glad that in the end common sense has prevailed in the European Parliament, in the Commission, concerning the causes of this financial crisis. People have realised that this crisis is not of a cyclical nature, that a thorough overhaul of the regulation and supervision of financial markets is badly needed, that the Larosière Group report and the Turner report too have made it quite clear. These reports are in analytical tune with the Lamfalussy follow-up report of the Parliament. The documents which are debated today are to be seen in the same logic of action. Unfortunately, our economies will still suffer for quite a while, not least because of the public budgets and probably future inflationary effects of the efforts which are being undertaken to clean up the huge mess. Let us hope that we will learn this time more than it was done out of previous episodes of crisis. Thank you.
I can't see Mr. Bartolozzi, who was the next speaker on our list, so I will give the floor to Mr. Lehner for 2 minutes.
Lehner, you have the floor now.
Präsidentin, meine sehr verehrten Damen und Herren!
President, ladies and gentlemen, this has been a good and interesting debate for the simple reason that we are combining two different aspects in the reports which don't seem to be linked at first sight. But they are certainly important. They are linked if we want to manage the crisis, tackle the crisis. The Weber report, first of all, I want to thank and congratulate Mrs. Weber. This is not a classic approach to tackle the crisis. Really, what this is about is simplifying social law in order to reduce bureaucracy and the burden on companies. I think towards the end of this Parliament's life, this is a clear proof and example as to how the European Parliament is tackling this issue and is trying to change company law in the interests of the companies themselves. And I think that's something to be warmly welcomed. In this debate, we have an opportunity to say something about general financial market legislation. Again, I think that towards the end of this Parliament, we're sending out a signal that we are coming to the final conclusions of the financial packages, the first financial package. I think that's important too at this stage. I want to point out as well that the second package, which the Commission is still preparing, well, unfortunately, it's too late for us to conclude that. There are reasons for this. You'll remember that in the past, the issue of regulation or deregulation of certain areas of the financial market was discussed. There was a committee set up in the Parliament, and obviously, repeatedly, we discussed this in plenary. But there was a lot of resistance to what was being mooted. There was resistance in the Council of Ministers. Gordon Brown refused to recognise certain realities. There was resistance in the Commission. The Commission, for example, when it came to hedge funds and other sectors, they resisted any move for a long time. And again, there was some resistance in the Parliament to getting legislation in place. And some people felt that there was too much authority be given to the wrong bodies. Charlie McCreevy is now regulating hedge funds. Mrs. Berges is drafting an initiative report on this, and Gordon Brown has also changed his opinion. So that's a positive development which I warmly welcome on behalf of my group. Thank you.
Thank you very much indeed. Now we have arrived at the time for Catch the Eye. Mr. Audy has the floor. First, 1 minute, please.
Merci, Madame la Présidente.
Thank you, Madam President. Well, I would like to pick up on the point on the credit rating agencies. And I'd like to start by congratulating my colleague Jean-Paul Gauzès, who has worked in a very pragmatic, efficient way. Now, I may be a little bit off the point, but I would like to talk about the rating of states who have become major financial players in this crisis in the face of the risk of the collapse of the financial sector. They have run up debts, they have been involved, and that's why I was wondering whether the EU shouldn't suggest, under the new world regulation of capitalism, that we should maybe set up a public global state rating agency, an independent structure which would work through the IMF and will allow citizens to understand through these ratings what the quality of financing is of these states who have become uncontrollable financial operators. Thank you, Mr. Gauzès. Mrs. Round has the floor. 1 minute.
Mr. Lauck.
Madam President, thank you. 3 brief points from me. I think we have a good consensus whereby all institutions must be regulated in future. There can be no exemptions, and the Commission is now in a position to put forward proposals encompassing all stakeholders. That is urgently necessary. Secondly, we need to think about what to do about European regulation, how to build it up, bring it under parliamentary control, and ensure that there is proper independence of American regulators, whether formal or informal, because they've obviously failed. Then, thirdly, the euro area, the spreads and indebtedness of individual member states within the euro area are diverging rather than becoming more harmonized. We need, therefore, to establish greater discipline and reverse that process. And finally, the EU must not run up further debts, because the member states have run up enough debts themselves. Thank you.
Thank you. Mrs. Beres has the floor.
Thank you, President. Mr. Lehner, those who wanted legislation on hedge funds were the socialists in this parliament. It was their determination which has made sure that we could get this legislation on their funds. And also in the Gauzès report, we asked that the Commission should work on the idea of a public credit ratings agency. So I just wanted to point out to the Commissioner that I'm astounded at this current situation where there are 2 measures in the monopoly of the legislative initiative of the Commission. When we asked the Commission to come up with a proposal to harmonise the guarantee of bank deposits, we got it 3 weeks later when the European Parliament took an own initiative report on the basis of the Polnu Rasmussen report, and it was voted through by a large majority in plenary. You simply put the proposal on the table for consideration at a time when the European Parliament can no longer debate it. We asked that legislative initiative be taken in this field last September. What have you done since then, Commissioner?
Thank you, Mrs. Beres. We don't have anyone else asking for the floor, so I'll give the floor now to Commissioner McCreevy.
I express my appreciation and admiration for the efficient handling of these 3 files by the Parliament and the 3 rapporteurs in particular. This has resulted in a quick consensus which will definitely improve the functioning of our financial markets. The new regulation on credit rating agencies will improve integrity, transparency, responsibility and good governance in the credit rating activities. Mr Purvis asked a couple of questions in this particular regard regarding the freedom to invest in particular products. Now, investment is free to all products, whether from the European Union or not. Ratings are not mandatory, so EU firms are not obliged to invest in rated products. But, may I stress, for regulatory purposes, that is, calculation of capital requirements, the ratings that can be used are those either issued in the EU for both EU and third country products, or endorsed or recognised as equivalent in the European Union. That may deal with the particular point that he raised. Although I am disappointed with certain aspects of the agreement on Solvency II, as I outlined earlier, the EU will have a framework for the insurance industry which can serve as a model for similar reforms internationally. Of course, this is not the end of the story. Much work remains to be done. Implementing measures will need to be in place sometime before October 2012 in order to give Member States and the industry some time to prepare for the introduction of Solvency II. And I can assure you that the Commission will play its role in order to facilitate this process and put these long overdue reforms into practice as soon as possible in the interest of all the parties involved. And even though I referred to this in my earlier introductory remarks, I would just like to stress again that group supervision remains in the proposal of Solvency II, although group support is out. I think it is just important not to get the two concepts mixed up entirely. And finally, with the simplified reporting and documentation requirements in the cases of mergers and divisions of public limited liability companies, the agenda on the administrative burden reduction is advancing, and this will contribute to the potential for growth and help Europe on the way to economic recovery.
Now, thank you very much. And now, rapporteurs, starting with Mr. Gauzès for 2 minutes. Thank you, Madam President. I'll confine myself to 2 or 3 brief points. Firstly, on the rating agencies, there is a broad agreement in the House, and European regulation will evolve over time. For the time being, it is exemplary regulation and could be the basis of an international agreement. I'd like to thank Mr. Pittella, Mr. Klinz, the shadow rapporteurs with whom I work very closely. I'd like to thank the Commission services, the Presidency, and of course the Secretariat of the Economic Affairs Committee, without whose experts I couldn't have done my work. Thank you.
Thank you, Mr. Gauzès. Mrs. Weber has the floor.
Thank you, Madam Chair. It was quite interesting to listen to all the speeches this morning in the Parliament, in a time when not only we are living in the toughest financial and economic crisis, but also, obviously, European elections are approaching. The reports we discussed today and we will vote tomorrow are not meant to solve the financial crisis, but what we hope is actually that they will help us in the future to avoid mistakes, at least major mistakes, and hopefully they will support a relaunch of the European economy. You know, when one hears that today small enterprises have to spend 10 times more than big companies in order to comply with EU legislation on reporting requirements, it is normal to wonder why is this and how we have come to rules which through their effects actually may kill these small enterprises, and why it took us so long to change this. I am glad that Commissioner McGreevy mentioned that the company laws is probably the toughest in the EU acquis communautaire, and maybe it is time to change it, certainly not to make it softer, by no means, but more in line with the current realities we are living. If we want to be more efficient, I think that it is better to put our energy on being constructive, and I think it is fair to say that what has happened with this package that we discussed today is a proof of this, is a proof that we have acted as responsible people and we have reached a compromise with the Council and the Commission in order to adopt this package in first reading. Can we do more? Certainly, but let us vote this and work in the right direction. Thank you.
Thank you. Well, the debate will be closed by Mr. Skinner, who has the floor for 2 minutes.
I'd like to start off saying what perhaps I should have said first of all, which is the thank you to all the services, to the Commission, the Council, and particularly the Parliament for the work that they put into this, which I have to say, without their work and without their help, we wouldn't have achieved. Like many around the room, we're quite astounded by the level of technical detail that goes into many of these reports. But let's say about Solvency II, that it was forged outside of a crisis to face a crisis. It has risk management in it, and as many people have heard round the room, this is a first for much of the financial services legislation. It also does, and I agree with the Commissioner, contain group supervision, and group support unfortunately is out, but we've heard all about that. Let's hope we can get that back. Capital is defined as well. Many aspects of this report make it a world leader. But my second point is about the strategic impact of using such legislation. In many respects, just having a regulation that works over 27 member states isn't going to be helped if we don't have the twin, which is a strategic regulator at a European level, which works over 27 member states as well. We need to overcome the differences that exist between regulators and make sure that we speak with one voice. It's particularly important when we come to recognise regimes elsewhere in the world. And I met with Paul Konjalski, chair of the subcommittee on finance in the US Congress just this weekend, and others who are now talking about accelerating the prospects for a single regulator at a federal level in the United States. If they do that before we do, we could be severely embarrassed by not having the regulator we need at a European level. This is a report which is at a global level, a global measure, a process by which we can all feel proud. But we also need to make sure that we continue to push for the changes under the de Larosière issues which have thrown up, and also on the group support which bring about economic efficiency. And I hope that everybody can support those measures. Thank you.
Well, that closes our joint debate. Mr. Gauzès's report will be voted on Thursday, and the reports from Mrs. Weber and Mr. Skinner will be voted on today. Turning to our agenda now, we have a joint debate on the facilities providing financial assistance. This is the report from Mrs. Berès on the mid-term financial assistance for Member States' balances of payment.